Crude oil, though, rose the most in almost 6 months after an unexpected drop in gasoline supplies. Crude ended yesterday back above $70 a barrel. Question, though, is will it ever break out of that $65 to $75 trading range it has been in for the last 4 months? We're going to ask that question of Ed Morse, head of economic research at LCM Commodities. Ed is the former head of commodities research at Lehman Brothers and previously served as the head of energy for the U.S. Department of State. Ed, you've been a remarkably accurate predictor when it comes to oil prices, especially coming out of the big bull market in commodities. 65 to 75, that's where oil's been. We did have that big move yesterday. Do you think oil is poised for a breakout?
Well, the market expects it to break out. The problem is the market is split as to whether it's going to break out above or below. And I think the probabilities are we're going to stay in this range for a while, but by the time we get to winter, the pressure is going to be on the downside, not on the upside.
Because of the build in supplies?
Well, the inventories are, as a whole, keep building. There's no sign of an upturn in demand globally or in the U.S. And even with winter coming, the amount of distillate gas oil, heating oil in storage is just at record levels.
Okay, one of the exogenous factors out there is always Iran. This story has been heating up lately. How do we think about it in the context of oil prices? What does it really mean?
Well, what you have to think about it is in terms of the probability of an event. And I put the probability of a military event in a 10 to 20% range. That's not high. It's not low. But it's not that probability that one worries about. It's the risk associated with the probability. What's going to happen to oil flows through the Strait of Hormuz? So it's a very low probability, but it could have a very high impact.
No question, no question. Let's talk about some of the other factors that go into understanding what's going to happen to oil prices over the next several months. Climate. We heard from Matt Rogers the other day that he's forecasting one of the coldest winters in a decade here in the Northeast. We consume a lot of fuel here in the Northeast, gas, natural gas, obviously heating oil. Do you agree or do you buy into that idea? And if so, is that going to drain the build in supplies and maybe add a bullish tone to the market if it's true?
The only thing it can really do is reduce the supplies we have this winter and make the spring market less treacherous than it otherwise might be, because we have an abundance of natural gas inventories, an abundance of heating oil supplies, and if we don't erode those inventories, by the time we get to the second quarter, the market could have a very bearish outlook again.
Okay, well, let us talk, though, about the potential for a bearish retreat in oil prices. We talked about the things that might help oil prices rise. What about the downside risks to the price?
The downside risks are really supply related. Let's assume that supply stays at the rate we have now. We have a lot of inventory to erode. But the problem is OPEC countries have a lot of pressure to produce more. Cheating keeps increasing every month. 2 OPEC countries, Angola and Qatar, have 500,000 barrels a day of new supply. What are they going to do with it when it comes on the market by December? And meanwhile, all the forecasts about Russian production going down, Caspian production going down are not true. Russian production is up. It's up this year, and it will almost certainly be up again next year over this year. So we have a supply overhang to worry about.
That's the supply side. On the demand side, is that really just a function of global economic growth at this point?
It's a function of global economic growth largely, but there's another spin to it, and that spin is every time we've had a price spike, demand growth has been significantly lower coming out of it than people have thought. And I suspect we'll have the same kind of situation arising the next time global growth rises again.
And very quickly, a lot of pressure from Gary Gensler, the chairman of the CFTC, trying to limit speculation in the oil market. That's what he says he's going to do. Is this creating enough of a chill that that's really not going to be a factor in oil trading for the foreseeable future?
No, there is a chill, but for Gensler to get what he wants requires legislation. What he wants to do is regulate the over-the-counter market. He can't do that without new legislation, and there have been a lot of good reasons not to go in that direction, and that's an uncertainty.
Ed, thank you, as always, for joining us. Ed Morse from LCM Commodities, right here in the studio, talking about the future for oil prices.